Good morning, everyone. I'm honored to be here this morning, and thank you, the organizers, for inviting me. As introduced, I'm Peter Kyambadde, Director, Tax and Corporate Services at KPMG, where I've been for the last 18 years. And so I've been in this tax space for quite some time, from time of university. I worked a little with the Uganda Revenue Authority and now with KPMG. And I do my work basically based in Uganda, but also across the East African region. The topic we are going to address today is a very, very key topic, that is taxation. And if we are going to go into analyzing the key issues to consider in mergers and acquisition, tax should be and is one of them. And why is it so? I say that as you start a business, or as you acquire a business, or you go into any transaction where you expect to make a profit, one of the key shareholders you have to take into account is the taxman. So a taxman is a shareholder in your business. And for example, a number of countries, for example, Uganda, whatever profit you make, as long as you have a profit, the taxman will have 30% of it. And is such an important shareholder that he will take his share even when you have not declared dividends. Other shareholders will only take, like, according to our laws here in Uganda, it's only at the point when there is profit and you have declared dividends that the other shareholders will be entitled. But the taxman is a different scenario. And if you do not manage your affairs, or you do not take into consideration all the aspects that you should, then his share goes higher than 30. For Ugandan's case, or many of the countries, they have 30, some have 25, others have 45. But they could even take 100% of your profits if you do not manage the affairs well, because they will charge you interest, they will charge you penalties, which other shareholders may not. So that is the importance. And that's why, as we look at mergers and acquisitions, it's a key area that we should look at. So, my presentation is going to look at the following aspects. We'll look at aspects that we need to consider from a tax perspective during the due diligence stage. Then, within the sales and purchase agreement, there are several clauses in there that we need to make sure that also take into account the different aspects of tax that has been either discovered during the due diligence stage or moving forward into managing and running the entity that has been either acquired or merged, so that you make sure that you're managing it properly. Then the tax aspects to take into account at the deal structuring stage, and then managing the entity and at the point of exit. And then we'll have also questions and comments at the end. So, at the tax due diligence stage, it's important that as we review the entity that we are planning to acquire, certain aspects are taken into account. Key of these is analysis of the internal control environment from a tax perspective of the entity that you are planning to acquire. In this case, an analysis of the capabilities of the team managing the entity that you are going to acquire is key. Because at the due diligence stage, we are trying to check the tax risk that may exist within that entity. Because as you are taking on an entity or merging with an entity, as I have said, if the tax risk is not well managed, or if the risk is high, then your radar has to be higher as you try to assess the extent of the risk that exists. So the team management capability needs to be assessed and see if it is weak, then your due diligence process to try to check the level of risk has to be higher. If it is strong, then probably, yes, you still need to do the risk analysis, but maybe the procedures you may take may not be as rigorous. Then we also check the internal tax review processes. And to the extent that you find that they are strong, then the level of analysis that you do may not be as rigorous. But if they are weak, then we have to make sure that the due diligence process is much more rigorous, and the aspects that we need to look at have to be expanded. And it's also important to check the external capabilities of the external advisors. To the extent that we have weak external advisors, then your process still needs to be strengthened. There are entities like in our markets, whereby you want to acquire an SME, and you find that the advisor in place is the kind who will tell you how much tax do you want to pay. And then they work the numbers to give you the tax that you want to pay. So, if you have such advisors, and this is an entity you are planning to acquire, then the level of risk will be extremely high, and the process needs to be much, much more rigorous. The other aspect that we need to check at the tax due diligence level is identification of the potential liabilities, tax liabilities, and other exposures. In which case, it's important that for the entity that you are going to acquire, you need to look at the specific industry tax issues in respect of that country where you are going into to acquire a given entity. Because then as you do your due diligence, your tax due diligence, you need to check whether the risks within the industry have been taken care of. And at the same time, other than looking at just the industry, you look at the specific entity issues to check whether the entity which you want to either acquire or merge with is taking the tax risks according to that industry into account to manage them properly. And this should be looked at in all the tax heads, from corporate income tax, if it's a group entity, from a transfer pricing perspective, then risks in relation to employee taxes, VAT, if it is an entity that is dealing in vertible services, withholding tax, and customs taxes or other international taxes. The other area to analyze is deferred tax, because in a number of instances, you find entities, say, having deferred tax assets, and this is contributing to their balance sheet. However, without checking how these were arrived at, you may find that that asset actually does not exist, in which case it may never be realized. So the review of the deferred tax number is key to look at the tax due diligence stage. Then, identification of tax liabilities that exists already or a potential exposures, which requires us to review the entity and find out whether there have been tax audits that have happened in the past. And in instances where there have been audits, it's important to find out whether the liabilities that could have been identified have already been taken care of, or the issues leading to those liabilities, to find out whether they have been dealt with. If there are lapses in the way you are managing the tax, have those been dealt with subsequently? If there are exposures that have already that were discovered but have not yet been made good, what is the plan to make them good? If there are potential exposures, have provisions been made in the books? So that is an area that is key to make sure that before you finish your tax due diligence, you have clarity over. And then once you conclude your tax due diligence, it is important to consider the way forward, in which case you may have to have a discussion. If at all there are liabilities that have been discovered during the due diligence stage, tax due diligence stage, should they be cleaned up before you take on the entity? In which case, should they be declared to the tax authorities and payments made? Or are you going to consider to have indemnities and warranties to protect you after taking over the entity? In which case, if there are liabilities that may crystallize after, one of the aspects which could be considered is having an escrow, whereby some money is put aside so that in the event that that liability arises, then that can be made good. And the other aspect, the tax aspects that may arise, you could consider to make a net debt adjustment if at all there is any amount due to the shareholders. Then the other aspects is to do with the sale and purchase agreements. As I said, in the sale and purchase agreements, there are a number of clauses, and as we review and put together the sales and purchase agreements, it's important to make sure that tax-related aspects are taken into consideration. Because subsequent to that deal, when the tax authorities are reviewing how the deal went, the sale and purchase agreement is one agreement that they normally ask for. And some of the things that have been put there could expose the new entity or the new shareholders if they are not thought through properly. And also it's within the sales and purchases agreement that you need to ensure that certain things and protection measures are made to ensure that the liabilities that may have been identified or potential liabilities do not hurt your business at a later stage. So, generally, as we are all aware, the sales and purchases agreement has the following basic structures where you have definitions, agreement to sell and purchase, in which case it could be a share or asset deal, and each of those, if it's a share or asset deal, the tax implications may be different. And we'll be looking more at what needs to be considered if it is a share or asset deal. Then the base consideration. The base consideration would give certain values, which would be of interest to the tax authorities at a given point to determine certain aspects, let's say if there is CGT, that is capital gains tax. Then adjustments to the considerations. As I've said, if there are going to be liabilities identified at the tax due diligence stage, then probably there could be adjustments to the consideration to be made, and that needs to be clear within the agreement. Then conditions precedent are stock vendors' undertakings, which would help to protect the buyer in case certain things do not go right, and also to agree on what needs to be done by the vendor to ensure that certain tax risks are managed. Then actions on completion. This is key because normally defines the time, place, and when the transfer of consideration has to be made. And these are key from a tax perspective. For example, the timing. Assuming the deal requires VAT to be paid, then the timing as to when it's done and when taxes like VAT are due is key. If it is not done at a given time, then certain liabilities may arise. Then, of course, warranties, as I said, for protection of things, if things go wrong. Then, that is, if certain exposures, tax exposures that have been identified actually crystallize, it's important to have those warranties in place, and that needs to be clarified within the agreement. Then indemnities. We need to decide and agree and document that if given liabilities arise, who is going to be responsible. And then there are sometimes other schedules and appendices to give more details. So some of the key aspects that to consider under the SPA is, as I said, the SPA provides for protection mechanisms to either adjust the purchase price if at all there are liabilities that have been identified at the tax due diligence stage, or get some money back in case certain exposures arise. Warranties and indemnities, I've already spoken about it, the importance of making sure that that is included in the SPA. And if certain conditions precedent are not met, possibility of even going out of the deal. Because as I've said, if you do not take care of this, taxes have had instances where businesses have closed. An investor comes in, he acquires an entity, and they didn't do their tax due diligence well. Then 1 year down the road, they find that the liabilities that are rising actually are much higher than any profits that they can do, and they close the business and move on. So it is very, very important that conditions precedent are very clear so that you do not lose your investment. Then security for damages, whereby you can postpone part of the purchase price, such that if at all certain exposures arise, tax exposures, then that part of the purchase price would be used to make good those exposures or liabilities. And if they do not arise, then you can pay up. Then I already talked about the escrow for purposes of putting money aside, and then bank guarantees, so that you protect your investment. Then the other aspects would be payment of a purchase price, whereby if you are going into a jurisdiction like Uganda, where we have capital gains tax, sometimes you come to acquire an entity. It is important to know at what point capital gains tax arises and who is responsible. Because you are acquiring from a shareholder and you pay your consideration, and probably the guys you are acquiring do not make good the capital gains tax to the tax authorities. For example, in Uganda, capital gains tax is paid at the year end. That means at the point the company is making its tax returns. The deal may have happened and been concluded, let's say, in June. If the year end for that company is December, capital gains tax will only be paid by the end of December, when the company is making its return, its amended return, and which would make sure that the final taxes are paid by June of the following year. So you may pay your consideration in June, and these guys actually do not take care of the capital gains tax. And down the road, the deal is concluded, maybe a year or two, the tax authorities come to do a review. And then at that point, the question is, there was capital gains tax due on this transaction when this company sold these shares. So Maybe the shareholders are still there or not, but in most instances, the tax authorities first go to the company because those are the people they see. And that brings issues which you may have to deal with, despite the fact they are not your issues. So it's important to have that clarity and ensure whether VAT applies to that transaction. Because if you are going to do a share deal, maybe VAT may not apply in some jurisdictions, whereby it will be taken as a going concern, and in many instances, whereby a share deal is not vatable. But there are instances whereby you are doing an asset deal and VAT is applicable. So the question is, when is it due and who is responsible? Stamp duty. When you are transferring these shares, there's stamp duty that arises. In Uganda, it's 1.5% of the value. So the question is, who is going to take responsibility? In most cases, it's the buyer that takes responsibility. But sometimes people agree that this other person is the one, maybe the seller or the vendor is going to take responsibility. But it needs to be clear within the agreement. And withholding tax issues, before, when you're making the consideration payment, who is going to take charge of that? So that needs to be clarified also. Then it's important to check whether the expenses that are being spent during the deal are going to be deductible to the entity that exists, or the new entity that is being formed. So the deductibility and who is going to take those expenses, first of all, from a legal perspective, who is entitled, and also clarity needs to be done between the two parties. And then to know the carry forward of losses. Is the kind of deal allowing carry forward of losses? And which entity, because if, for example, it is a share deal, generally, the entity that remains will carry forward the losses, but are they allowed or not? So it's important to have clarity on that. A number of jurisdictions, carry forward of losses is for a given time. Yes, you could have tax losses, but are you entitled to carry them forward or not? Then within the SPAs, we also normally have conduct clauses, whereby it is important to agree and ensure that the obligation to inform other stakeholders of the event, like the event that is the transaction, is done to avoid future liabilities. Because, for example, within the laws, like in the Ugandan law, once you have done this transaction, for you, for example, to get the VAT exemption, if at all it's a going concern transaction, URA has to be informed within a given time. And it's important that that is clarified at the point you are entering into the agreement. Otherwise, if that is not clear, this may not be done, and the exposure arises later, and then you start having a back and forth. Who was responsible to have done that and provide that information to the other stakeholders, like the Revenue Authority. Then, for the people taking over, because in mergers and acquisitions, sometimes some people go out. Let's say the former shareholders are taken over, and they move, and they go away with certain records, which are very, very relevant for purposes of ensuring that tax risks are managed in the future. Because in tax reviews or tax audits, it is the information that you have that normally saves you from the taxman. You may have done things right to the extent that you cannot support them with documentary evidence. Then the taxman will say, yes, we hear you, we see it on the record, but where's the evidence to prove it? So, as the people go out,